Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 14th, 2025. Good morning, everyone. I hope you're all ready for an in-depth look into the markets today because we certainly have plenty to discuss, analyze, and even chuckle about along the way. Let's jump right in.
Let's start with a quick market overview before we dive into the broader trends. The S&P 500 index closed at approximately 5,592.54, marking a gain of roughly 0.51%. That modest climb comes on the back of a volatile period, and while the day's increase might appear reassuring, the broader picture tells us a more complicated tale. Over in the Dow Jones, we witnessed a close near 41,183.89, up by about 0.31%, while the Nasdaq ended at around 17,588.35, with a gain of 0.37%. The Russell 2000 index, representing smaller companies, finished today at about 2,018.07, moving up approximately 0.48%.
In the world of cryptocurrencies, Bitcoin showed some vibrant energy, posting a price around $83,288.98, a robust gain of roughly 2.71%. Ethereum wasn't left behind either, as it reached close to $1,921.63, up by around 3.12%. While these upticks are certainly impressive on the surface, as seasoned investors, we know that individual movements seldom tell the whole story of market sentiment and the underlying drivers at play.
Now let's take a deeper dive into major market trends today. Over the past few weeks, there's been a significant shift occurring that has caught the eye of many. The U.S. stock market has reportedly lost $5 trillion in value over the course of 3 weeks. Yes, you heard that correctly, $5 trillion. The S&P 500, one of the primary bellwethers, has fallen in excess of 10% from its record high, neatly sliding into correction territory. This isn't just a headline, it points to some underlying economic forces that are still very much in play. Investors are grappling with a mixture of high valuations, geopolitical uncertainties, and a lingering debate about the pace of monetary policy normalization. When you see correction levels in major indexes, it's an invitation to question both the sustainability of recent highs and the future economic trajectory.
But that's not all. As intriguing as the swings in the index may be, there's another side to today's narrative that involves our financial institutions. Several reports point out that banks are currently noticing cracks in the economy due to evolving consumer behavior, particularly as the pressure of inflation and tariffs begins to bite. According to multiple accounts, banks have observed a decline in credit card spending, and delinquencies are rising in sectors that were once considered resilient. Now, I understand that for some of you, particularly those in consumer discretionary and finance sectors, this might raise an eyebrow or two. Is this a harbinger of a longer-term trend in consumer behavior? And more importantly, what does this mean for lending standards and bank profitability as we navigate these choppy waters? These are questions worth pondering, not only from a macroeconomic perspective, but also when assessing individual stock positions within the financial sector.
Shifting gears, there's some noteworthy news from the corporate finance arena. We're seeing a buzz around Citi and Apollo, who are said to be offering a private credit option in the sale of a Boeing unit. This move is particularly intriguing as it represents a creative financing structure, hinting at both the complexities and the opportunities that arise when traditional banks find themselves partnering with private credit firms. It's a sign, perhaps, that we're entering an era where unconventional financing is not just a high-risk play, but also a strategic response to the evolving demands of corporate reorganization and streamlining. It begs the question, how might this private credit landscape alter the dynamics of corporate financing in the coming years? For anyone watching the financial heavens, this is definitely an area to keep an eye on.
And then, of course, there's the energy market, a sector that often acts as both a barometer and catalyst for broader economic sentiment. Oil has had its own dance this week, with oil futures turning higher as investors kept a close watch on the unfolding Russia-Ukraine talks and the persistent tariff threats looming over global trade. Brent crude, now impressively trading above the $70 per barrel mark, underscores a turnaround that brings both relief and concern in equal measure. The rise in crude prices offers some hope for oil-exporting nations and energy stocks, but it simultaneously raises questions about global inflation pressures and the ripple effects on economic growth. We can ask ourselves, will the rise in oil prices spark a broader inflationary spiral, or is this simply a transient reaction to geopolitical uncertainties?
Let's take a moment now to unpack these stories a bit more thoroughly, as we have several key narratives that are shaping investor sentiment today. First, the market correction, which some might attribute to a once familiar bubble-popping scenario, is a stark reminder that even the most robust rallies can be met with reality checks when fundamentals start to shift. The loss of $5 trillion in market value is not a small matter. It's a glaring indicator that market exuberance may be gradually giving way to caution and recalibration. We all love a good rally, don't we? But when the numbers start flashing red, it's wise to reassess portfolios and ask whether our risk assessments are aligned with the current macroeconomic conditions.
On the banking side, we're noticing a genuine sense of discomfort as consumer spending patterns evolve amid high inflation and geopolitical freight. Banks, traditionally seen as economic stabilizers, are now finding themselves at the forefront of consumer credit concerns. The lowered spending on credit cards, coupled with rising delinquencies, might be signaling an upcoming shift in consumer behavior, a contraction in disposable income, or perhaps more cautious borrowing as households brace for economic uncertainties. It isn't all doom and gloom, though. These very concerns can sometimes open doors to innovation, from fintech disruptors offering novel credit solutions to banks revisiting their risk management frameworks. The interplay between traditional banking and emerging alternatives is fascinating, and a reminder that adaptation is key in this fast-changing environment.
Now, coming back to the private credit option offered by Citi and Apollo in the context of the Boeing unit sale, this represents a blend of traditional corporate value and innovative financing mechanics. If you're an investor, this should prompt you to consider the broader implications for corporate debt markets. The trend towards creative financing might usher in an era where financing solutions become more flexible and tailored to specific corporate needs, potentially offering higher yields at the expense of increased complexity. What do you think about this emerging landscape? Could we be witnessing the beginning of a paradigm shift in how sizable corporate assets are financed, or simply a temporary adaptation to current market pressures? It's definitely worth a few extra moments of thought as you plan your next moves.
Then there's the energy sector. Oil prices, influenced by geopolitical maneuvers and tariff disruptions, paint a picture of uncertainty but also opportunity. Brent crude's recent climb above the $70 threshold is significant because it disrupts the price psychology that has kept oil trading in a cautious zone for some time now. While higher oil prices can boost returns for energy companies and nations dependent on oil exports, they can also quickly filter through to heightened input costs for consumers and businesses alike, fueling inflationary pressures. The challenge for policymakers is to balance these competing interests, ensuring that a rise in energy prices does not inadvertently stall economic growth by increasing costs across the board.
Beyond these primary stories, let's bring in some additional layers for a more comprehensive coverage. Amid the market correction debate, you might have noticed that the media has been echoing similar headlines repeatedly about the stock market losing $5 trillion in value. Why do we see so many identical stories? Part of the answer lies in the dramatic nature of the numbers. It's as if every headline is shouting, "This is significant." And while the repetition highlights the severity of the situation, or can also lead to analysis paralysis among investors. Is it merely a phase of market volatility, a reflexive reaction to economic challenges, or a deeper structural shift in investor behavior? The answer likely lies somewhere in between, and prudent investors should remain cautious and critically evaluate what these repeated headlines imply over the long term.
Let's not forget the narrative around bank once again. The reports highlighting lower credit card spending and rising delinquencies have been making the rounds with almost an echo chamber effect. But here's a thought. Perhaps these reports, while sounding alarm bells, might also be an opportune signal to re-examine the health of the consumer sector. After all, lower spending could be a precursor to more sustainable long-term behavior if it means that households are prioritizing debt management over immediate gratification. For banks, this is a wake-up call to ramp up their credit risk models and perhaps invest in more robust predictive analytics. It's almost like a little financial personality test. Are you the spending type, or are you preparing for tougher times ahead? Just a bit of humor there, but it does drive home the point that money management is both science and art.
For those of you with a keen eye on corporate finance trends, the Citi and Apollo story might seem like just another quiet maneuver until you realize its broader implications. Private credit options are increasingly becoming a topic of conversation among seasoned investors. This approach could represent increased flexibility in corporate financing and might lead to more bespoke, targeted investment opportunities. When traditional lending models begin to merge with private credit frameworks, investors could gain access to unique yield opportunities that defy conventional risk-return assumptions. It's a bit like discovering the secret menu with your favorite restaurant. There's something special in store if you know where to look and how to order.
Moving on to sector analysis, let's unpack a few key themes. In technology, while we haven't seen headline-grabbing news directly affecting tech stocks today, The ripple effects from a cautious equity market and the current corrections in broad indexes do mean that tech companies could still face headwinds. With valuations coming under increased scrutiny, many tech giants are now moving from unbridled growth to more measured, sustainable expansion strategies. Every time you see a headline about a tech stock making a big move, it's worth asking, is this a one-time reaction to broader market sentiment or a sign of deeper shifts in the sector's fundamentals?
The energy sector certainly deserves a closer look. With oil prices making their recent descent and geopolitical tensions still simmering, energy companies are in a position where a robust balance between risk management and aggressive expansion is key. For those invested in energy stocks, higher oil prices might send signals of stronger revenue figures, but the potential increase in transport and production costs must not be ignored. It's a delicate balancing act and one that will test the agility of even the most seasoned energy providers.
When we talk about the financial sector, the reports of declining consumer spending and rising credit delinquencies are particularly poignant. Banks are traditionally seen as the backbone of economic stability, but even these institutions are not impervious to shifts in consumer behavior. The ongoing struggle to reconcile higher interest rates with a cautious borrowing public poses a challenge that could have long-reaching implications. It forces one to ask, how will banks adapt their lending practices in the era of evolving consumer patterns, and what might this mean for investors holding banking stocks?
On the global front, the corrections and the varied performance of different sectors in the United States are sending ripples across international markets. European and Asian markets, which are intricately linked to U.S. economic trends, are likely to feel the aftershocks of these developments. In Asia, for example, where many economies are highly sensitive to commodity price fluctuations and interest rate changes, the interplay between rising energy prices and evolving consumer credit behaviors in America may well herald adjustments in monetary policy. Investors globally should thus consider how these shifts impact not only their domestic portfolios, but also their international investments.
To provide some expert insights and predictions, let me share my thoughts on what might be coming next. The current market conditions, characterized by pockets of modest gains amid broader corrections and cautious consumer sentiment, suggest that we may be on the cusp of another consolidation phase. While a complete downturn is unlikely given the resilient fundamentals in many sectors, a period of consolidation, where corrections become opportunities, is certainly on the horizon. The correction in the S&P 500, which has shed $5 trillion of market value, may prompt investors to revisit asset allocation strategies. Is it time to reallocate some risk away from overvalued sectors and seek strategic positions in undervalued areas? That is a question I urge you all to consider deeply.
Moreover, with banks tightening their credit and consumer behavior shifting, we could see a period where quality balance sheets and robust risk management practices come to the forefront. For those invested in financial stocks, this might be an opportune moment to focus on companies with strong fundamentals and diversified revenue streams. The convergence of traditional finance with innovative credit solutions, as showcased by the Citi and Apollo move, may also carve out a fresh niche for institutional and retail investors alike.
The energy sector, with its recent uptick in oil prices, is another arena where striking a balance is critical. While higher prices promise improved margins for oil producers, they also introduce uncertainty to global growth prospects. As an investor, ask yourself, am I adequately positioned for both the upside potential and the potential headwinds of a more expensive energy landscape? It's a fascinating dynamic, one that forces us to reconcile optimism with caution.
When considering all these elements, a few provocative questions come to mind. How do we, as investors, balance the transient nature of market corrections with the need for long-term strategic planning? And in an age where news cycles repeat headlines faster than ever, how do we distinguish between short-term market noise and truly transformative economic shifts? These are the kinds of questions that can keep even the most seasoned market participants awake at night, and sometimes it even makes for a great conversation over your morning coffee.
Adding a bit of humor to lighten the load, let me remind you that sometimes the market behaves like that one friend who promises stability but ends up being unpredictable. Just when you think you've got a handle on it, it decides to take a wild roller coaster ride. And who among us hasn't felt like tightening our seat belts in anticipation of the next loop-de-loop? It's all part of the excitement, and yes, sometimes the head spinning that keeps us coming back day after day.
As we broaden our lens to look at global market implications, it becomes evident that the interplay of regional and domestic factors is becoming increasingly complex. For instance, while U.S. indexes show modest gains today, the reverberations of an overvalued market adjusting after a rapid run-up may soon be felt across European and Asian markets. Economies that are largely export-driven or that have high exposures to commodity prices will likely need to recalibrate their policies. For international investors, the current volatility underscores the importance of diversification across geographic and sectoral lines. It's a timely reminder that in today's interconnected world, local events can have global consequences.
In wrapping up today's briefing, let's highlight some of the key takeaways. First, while our major indexes S&P 500, Dow Jones, Nasdaq, and Russell 2000 showed modest gains today, the broader market narrative is dominated by caution regarding the hefty $5 trillion of market value that has evaporated in just 3 weeks. That correction serves as a reminder that even an upward-moving market needs careful scrutiny. Second, the banking sector is confronting the dual challenge of weakening credit card spending and rising delinquencies, forcing a rethinking of how banks approach risk management in an uncertain environment. And third, developments in corporate finance, particularly through the private credit solutions championed by Citi and Apollo, are redefining traditional financing models and posing intriguing questions about the future structure of corporate debt.
The energy sector, with oil prices rebounding amid complex geopolitical and tariff-related pressures, continues to serve as a bellwether for global economic sentiment. And while these individual stories may seem distinct, they all interlock to paint a picture of a market in transition, one that is both resilient and cautious, innovative yet rooted in fundamental challenges.
Before I sign off, I'd like to invite you to reflect on these narratives and consider how they align with your investment strategies. Are you in a position to benefit from a potential consolidation period? Do you see opportunity in the evolving landscape of private credit and energy markets? And what measures are you taking to prepare for possible adjustments in consumer behavior and credit trends? These questions are as much about the market's direction as they are about our personal financial strategies.
I know we've covered a lot of ground today, and if nothing else, I hope these insights have given you ample food for thought. It's always fascinating to see how seemingly isolated events, be it a correction in a major index, a shift in banking practices, or a surge in oil prices, can interweave to create a broader economic tapestry. And remember, wisdom in the investment world isn't just about following the headlines. It's about reading between the lines and discerning the underlying currents that drive the markets.
Thank you for joining me on this deep dive into today's market happenings. I'd like to give a special shout out to Pantheon AI, your trusted information co-pilot, for powering this journey through the intricate maze of market analysis. As you go about your day, keep these insights in mind, question the narratives you encounter, and never hesitate to challenge your assumptions. Our conversation today is just a snapshot of the ongoing evolution in the financial landscape, and I encourage you to continue engaging, learning, and sharing your views.
So as we wrap up this morning briefing, I leave you with some thought-provoking questions. What if the market correction we're seeing now is just a precursor to a more profound realignment in valuation standards? Could the banking sector's current challenges force a long-overdue modernization of credit risk practices? And how might these changes ripple out to affect global economic policies in the near future? These are not questions with simple or immediate answers, but they are crucial for anyone who intends to navigate the markets with both prudence and foresight.
I invite you to join us again tomorrow for another session of insights and engaging dialogue with our AI co-pilot. And as always, feel free to reach out with your own questions or insights. You never know when a conversation might spark the idea that leads to your next winning strategy.
Remember, learning shouldn't feel like a full-time job. Have a great day, and until next time, keep challenging the norms and questioning the status quo.